So the first valuation method that we'll start off with is an absolute valuation method called the dividend discount valuation. We've studied this method at level 1 as well. At level 2, we will revise a bit of what we've studied and we'll do more detailed and more complicated questions related to the dividend discount model. So the advantage of this model is that theoretically this is the best approach, especially for a minority shareholder. So the theory that the value of the stock is equal to the present value of the dividends that you get from the stock is theoretically sound. Secondly, dividends tend to be less volatile than other cash flows, giving this kind of an approach more stability than the others. The problem is that we can't use this model for firms that don't pay dividends, and if we cannot forecast the dividends with certainty, we cannot use this model. And dividend discount model, please understand, takes a minority shareholder's perspective. If you are the majority shareholder of a company, let's say you own 100% of a company, do dividends matter to you? All cash flows are anyways yours. Whether you invest them or you spend them, it is your own choice. Similarly, if you're holding 80% of the company, your view would be similar. Even if I pay dividends, 80% of them come back to me. And the call on dividend policy is my choice. I can decide to increase the dividend payout any day I like. So I am concerned about how much cash the business is generating. After that cash generation, whether I pay it out as dividends or not is my prerogative. So I am not too bothered about dividend payments if I am a majority shareholder. If I am a minority shareholder, however, let's say I am one of the people who own the remaining 20% in this company, then even though the business may be generating a lot of cash, but if the owner of the business or if this 80% shareholder doesn't ever share it with me as a dividend, but he invests in other businesses or he siphons it off maybe, or he does something else, whatever be, it doesn't come back to me as dividends. Then if the stock market was not there today, or if I wasn't able to sell my share to somebody else, then what am I dependent on? Or what are the cash flows coming to me from this company? It is the dividends. And if dividends are not sufficient, then probably the value of the company should not be so high as compared to another company that is paying dividends. Of course, if I feel the dividends are being reinvested well and they're growing the company, it's a different situation. But dividends are very important for the minority shareholder because the only cash flows he sees is the dividend. So the majority shareholder would normally not value the company using the approach that we will study next. So dividends will be an appropriate measure of a company's cash flows when first of all the company has a history of dividend payments, the dividend policy is related to the earnings, so if earnings are going up, dividends are also going up and vice versa. And the perspective is that of a minority shareholder as we just discussed. So given the financial information on Northern Napier, an electronics manufacturing company, determine whether dividend discount model is the appropriate model to value this company's stock. So DDM is not a good approach for this company, as even though the earnings are increasing, the dividend is constant. So dividend is not linked to the earnings of the company. In free cash flow models that we will study next, the next reading deals with free cash flow valuation. We don't estimate dividends. We only estimate free cash flow to firm or free cash flow to equity and discount it back to compute the value of the firm or the value of the equity. So these models, free cash flow models, will be more appropriate for companies that do not have a dividend payment history or the dividend payment is not clearly linked to earnings. So firms where free cash flows confirm better with the profitability, this approach will be more appropriate. And if the valuation perspective is that of the controlling shareholder, then he is most concerned with the cash flows that the business is generating. The last approach in absolute valuation that we will study is called the residual income approach. So we studied a little bit, or we got a hint during corporate finance of the residual income valuation. We will study it in more detail when we study equity valuation. So we compute the residual income and we decide whether the company has added to the book value or not. So for firms that don't have a dividend payment history and that have negative free cash flows also, we may have to resort to a residual income type approach. The only caveat is that we need good quality financial reporting data, good quality income statement and balance sheet, because the residual income doesn't depend on cash flows. It actually uses the income statement and balance sheet data for the valuation. So New Mountains are expected to pay dividend at the end of the year of $3. The analyst estimates the required return to be 10% and the expected price at the end of the year to be $30. The current price is $27. Calculate the value of the shares today and determine whether New Mountain is overvalued, undervalued, or properly valued. So we are asked to compute the value at t equal to 0, and it is given that at t equal to 1 we will get $3 in dividend, and we'll get additional $30 that are expected to come from the sale of the stock. So total $33 are expected to come at the end of 1 year. The present value of this, that is the value today, should be 33 divided by 1.1, that is equal to $30. So the fair value is $30 and a 10% return would mean 33 at the end of the year. The current stock price, however, is $27, such that the stock currently is undervalued. Please remember, we studied in return concepts. The expected return was how much? It was the required return plus the return from price convergence. So the required return in this case is 10% plus the return from price convergence, that is 30 minus 27 divided by 27. So if we buy the stock at $27 today, our expected return will be more than the required return. And we said that if expected return is more than the required return, then the stock is undervalued. Eastern Coffer shares are expected to pay dividend of $11 and $6 at the end of each of the next 2 years respectively. The investor expects the price of the share at the end of this 2-year holding period to be $115. The investor's required rate of return is 10%. Calculate the current value of the shares. So again, first draw a timeline, depict the expected cash flows and discount them back to compute the value of the stock. So $11 dividend coming at the end of the first year, $6 coming at the end of the second year, and after 2 years the expected sale price is $115. The required rate of return is 10%. We are asked to compute the value at t equal to 0. So at t equal to 0, this will be discounted back by 1 plus r, and the second complete cash flow will be discounted back by 1 plus r to the power 2, giving us our value. So please verify that this comes out to be $110 approximately. So just like we held the stock for 1 period and then 2 periods, we could hold it for 3 periods as well. So the dividends for the next 3 years are given 1.2, 1.44, 1.728, and at the end of the third year we are expected to sell it for $17.28. The required return is 20%. So we can similarly depict the cash flows 1.2, 1.44, 1.728 plus 17.28 and divide them, rather discount them back at the rate of 20%, giving us a total value of $13 today. Now we will once again understand the Gordon growth model in detail. The Gordon growth model assumes that if dividends are expected to grow sustainably till infinity at a growth rate of g, then the value of the company can be computed from the dividend discount model as d1 upon 1 plus r, d2 upon 1 plus r to the power 2, so on and so forth, d infinity upon 1 plus r to the power infinity. d1 is the next year's dividend. We are computing the value as of t equal to 0, and we discount back all dividends in the future to get to that value. If dividends are expected to grow at the rate of g, and d naught is the last year's dividend or the dividend that has just been paid. So if we purchase the stock today, we will not get this dividend. The first dividend we will get is the next year's dividend or the dividend expected at t equal to 1. So d1 can be written as d naught into 1 plus g. d2 can be written as d1 into 1 plus g, that is d naught into 1 plus g to the power 2. The third cash flow is d3, that is d2 into 1 plus g, because dividends are growing at the rate of g. So this will be d naught into 1 plus g square into 1 plus g, that is d naught into 1 plus g to the power 3, so on and so forth until infinity. The first cash flow, d1, will be discounted back by 1 plus r, the second by 1 plus r square, and the third by 1 plus r to the power 3, so on and so forth. The value is simply the summation of the present value of each of the individual cash flows. Now this series is called a geometric progression. A geometric progression is a series in which each term is the same as the previous term multiplied by a common ratio. So what is the common ratio in this geometric progression? So the common ratio here is equal to 1 plus g upon 1 plus r. So each term is the same as the previous term multiplied by 1 plus g upon 1 plus r. The sum of a geometric progression till infinity can be calculated as the first term, also known as a, upon 1 minus the common ratio. We proved that in 9th or 10th grade. You don't have to remember the formula, just for your explanation. This is how the Gordon growth model is derived. So the first term is d naught into 1 plus g upon 1 plus r upon 1 minus the common ratio is nothing but 1 plus g upon 1 plus r, such that the value of the firm will come out to be d naught into 1 plus g upon 1 plus r upon 1 plus r minus 1 plus g upon 1 plus r. 1 plus r will get cancelled, 1 will get cancelled, this will be r minus g. So this will be d naught into 1 plus g upon r minus g, which can also be written as d1 upon r minus g, where d1 is the expected dividend in the coming year. Blue Star has recently paid a dividend of $2. It is expected that the dividend will grow at a rate of 10%. Beta is 2 and the risk-free rate is 5%, and the expected return on the market portfolio is 10%. Calculate the value of Blue Star's shares. So expected return is simply RF plus beta into RM minus RF. Market portfolio is 10 minus 5, So this will come out to be 15%. Last year's dividend is given to be $2. So the value can be calculated as D naught into 1 plus G upon R minus G. D naught is 2 into the growth rate of 1 plus 0.1 upon R minus G, that is 0.15 minus 0.1, which will be 2 into 1.1 divided by 0.05, that is $44. Assume that the current price and the most recent annual dividend for Great Nickel are $20 and $1. If the required return is 10%, what is the implied growth rate? So D naught into 1 plus G upon R minus G is given to be $20, or 1 into 1 plus G upon 0.1 minus G is given to be $20, and we are required to calculate G. This is a linear equation in one variable. 1 plus G will be equal to 2 minus 20G, or 21G would be equal to 1, which implies G will be equal to 1 upon 21, that is approximately 4.76%. Now, a very important concept is that of the present value of growth opportunities. So, the dividend discount model says that the value of a company should be D1 upon R minus G. Assuming the growth rate in the earnings was 0, that is, the company didn't reinvest anything. Whatever earnings the company earned, it paid it out as dividends. So the dividends were the same as the earnings and nothing was reinvested, hence growth was 0. In such a case, what would be the value of the company? If just an amount even was coming till infinity or growth was 0, the value would have just been even upon R. That is the dividend divided by R. So this is the value ascribable to current earnings. So let's say a stock which has a total price of $20, earnings of $1, and a discount rate of 10%, or the required return on equity of 10%. That means even if this $1 was never expected to grow, but the $1 was expected to sustain forever, the value of the company should have been equal to 1 upon 0.1, that is $10. If the current value is 20, that means the market isn't just expecting that this $1 will sustain, the market is expecting that this $1 will grow. The remaining value is called the present value of growth opportunities, or PVGO. So the PVGO for this stock that has a total value of 20 is $10. And you can use this to judge that is there sufficient growth opportunity, or do you think the growth will be higher? So in the current stock price, $10 is ascribable to the earnings that have already come. Even if this level sustains and nothing else happens in the future, the value will be $10. The current stock price is $20, implying that $10 is ascribable to growth opportunities. Japan Motors shares trade at $90 with expected earnings of $10 and the required return of 20%. Assume shares are properly priced, and so price is equal to fundamental value. Calculate PVGO and the portion of the leading P by E related to PVGO. Leading P by E means current price upon next year's expected earnings. Trailing P by E means current price divided by previous year's earnings. So the expected earnings are $10 and a required return of 20%. So even if this $10 was to sustain forever, the value of the stock would have been equal to 10 upon 0.2, that is $50. So $50 are related to the current earnings. The total price is 90. So 90 minus 50, that is 40, is the present value of growth opportunities. The leading P by E can be calculated as the current price divided by the expected earnings. So of the 9 times that the stock is getting as P by E, 5 units, that is 50 upon 10, is ascribable to current earnings, and 4 units, that is 40 upon 10, is ascribable to growth opportunities or present value of growth opportunities. So 4 units is related to PVGO, or 44.44% of the firm's leading P by E is attributable to present value of growth opportunities. Now the Gordon growth model can also be used to help us calculate the justified or the fair values of the PE multiples. So we'll first derive the justified leading P by E ratio. So the price as given by the Gordon growth method is D1 upon KE minus G. D1 can be written as the earnings in the next year multiplied by the payout ratio upon KE minus G. The payout ratio can further be broken as 1 minus the retention ratio. So B here is the retention ratio upon KE minus G. If we take E1 in the denominator, this will give us as the price to earnings ratio, where E1 is the expected earnings, or the leading P by E ratio as 1 minus B upon KE minus G, or R minus G. If we were to derive the price upon the lagging earnings, that is last year's earnings, then E1 can further be broken up as E0 into 1 plus G is the same as E1, or price upon E0 can be written as 1 minus B into 1 plus G upon KE minus G. So these are the fair values of the PE multiple that the stock should trade at, assuming the earnings and dividends were sustainably going to grow at the rate of G. So B is the retention ratio, 1 minus B will be the payout ratio, E0 is the current earnings or last year's earnings, E1 is the earnings expected in the next year or the coming year, and the other terms have the usual meanings. If the stock's PE multiple is higher than the justified PE by E multiple, then we can say that it's overvalued. If the PE actually is lower than the justified PE, then we will say it is undervalued. Greenwater Incorporated is currently selling at $20 on current earnings of $4 and a current dividend of $2. Dividends are expected to grow at 5% per year. The risk-free rate is 2% and the market equity risk premium is 8%, and Greenwater's beta is estimated to be 1. Calculate justified leading and trailing P by E ratios of Greenwater Incorporated. So first let's calculate the leading P by E. So that will be price upon the coming year's earning, can be written as the payout ratio, or 1 minus the retention ratio upon R minus G. Please note, if you don't remember this formula at any point in time, it won't take more than 30 seconds to derive it. So from the Gordon growth model, just derive it again if you've forgotten the formula. In fact, don't try to remember it. As you practice more and more, it will stick to your memory anyways. So the retention ratio is given as, or can be calculated as, $4 were earned, of which $2 were paid out as dividend. So both the retention ratio as well as the payout ratio is equal to 50% or 0.5. So the price to earnings leading would be 1 minus 0.5 upon the required rate of return, that can be estimated as the risk-free rate, plus beta times the risk premium, that will come out to be 10%. So into 0.1 minus the growth, that is 5%. So the fair leading P by E multiple for the stock should be 0.5 upon 0.05, that is 10 times. Similarly, we can compute the fair lagging P by E. So if you have to derive P by E naught, it will simply be the P by E1 into 1 plus G, because E1 is E naught into 1 plus G, so 1 plus G will get cancelled, so it will be 10 into 1 plus 0.05, that is 10.5 times. So the justified leading P by E is 10 times and the justified trailing P by E is 10.5 times. You can use either for the purpose of valuation or comparison, but make sure it is comparable. So if you're comparing leading ratios, then for all other companies also compute the leading ratios. If you're computing or comparing lagging ratios, then for all other companies also you should compare the lagging ratio. Preferred shares normally give a fixed dividend till perpetuity. So preferred equity is like debt in that it gives us a fixed coupon. Preferred equity is like equity in that there is no fixed time to maturity or when the money will come back. So you can think of a preferred share as a dividend of DP coming till infinity, the present value of which will be DP upon RP. It will be the same proof as DP upon R minus G, only G is 0. So the formula will remain DP upon R. United Publishing has a fixed rate perpetual preferred stock outstanding with a dividend of 6% based on issue at par of $100. If the investor's required rate of return for holding these shares is 10%, calculate the current value of these shares. So 6% of the par value, that is $6, will be paid forever and will be discounted back at the rate of 10%, so that the fair price would be 6 upon 0.1, that is $60. The Gordon growth model that assumes that dividends will grow perpetually at the rate of G would be applicable only to stable, mature dividend paying firms, appropriate for valuing market indices, because individual companies can have very high growth rates or very low growth rates, some may be degrowing. Indices on the whole or countries on the whole grow at a constant sustainable growth rate till infinity. So it is okay or appropriate to value indices using the Gordon growth model. Is easily communicated and explained because of its straightforward approach. Can be used to determine implied growth rates, implied required rates of return, as we did in the previous review on return concepts, and computing the value of growth opportunities that we did in the current session. Can be used to supplement other more complex valuation methods, as we will see. So there are some characteristics that limit the application of the Gordon growth model. First of all, valuations are very sensitive to the estimates of growth rates and the required rate of return, both of which are difficult to estimate. The model cannot be easily applied to non-dividend paying stocks. Unpredictable growth patterns of some firms would make using the model difficult and resulting variations, or rather resulting valuations, unreliable. So D1 upon R minus G is the value. If growth is too high, this term will become negative, hence it cannot be used. There should be a constant G and a constant R, and there should be dividends. If this is unpredictable, then again you cannot use the model. So in a two-stage dividend discount model, which is more useful for many companies, we predict a stage 1 of high growth and a stage 2 of a low long-term sustainable growth. In an H model, the assumption is similar. So we have stage 1 of high growth and stage 2 of a long-term sustainable growth. However, the transition from stage 1 to stage 2 is not abrupt. So we assume that the growth rate linearly declines from a high to a low value, in this case from 15% to 3%. In a three-stage dividend discount model, we predict one stage of very high growth, another stage of medium growth, and a third stage of long-term sustainable growth. Generally speaking, companies follow this pattern to maturity. That is, there is a phase of high initial growth, then there is a phase of medium growth, and then there is a phase of maturity and consolidation. In the initial growth, earnings growth is high, significant capital requirements are there, profit margins are also high because competition hasn't yet caught up. Free cash flow to equity is generally negative as the firm is expanding capacity and reinvesting. The investment is justified because the return on equity that the firm is earning is higher than the required rate of return, so the capital is being efficiently deployed. Dividend payout tends to be quite low or even zero at this stage because the firm has very good investment opportunities which it doesn't want to miss out on. The model used to compute the value of firms in the initial growth phase would be a three-stage model: high, medium, and low growth. In the transition phase, growth is still above average but is falling. Capital investment now required is lesser. Profit margins have peaked and are probably falling. Free cash flow to equity may be positive or generally is expected to now be positive as reinvestments have reduced and is increasing. ROE tends to be equal to R, that is, incremental high return opportunities are less. So we have already capitalized on wherever growth was there or wherever the factory wasn't there, we've already put up a plant. Now we are reaping the benefits, but growing or finding new niches or new avenues is becoming tougher. Dividend payout starts to increase and the model to be used is a two-stage dividend discount model. From the transition, we move to the maturity stage, wherein the growth has stabilized at some low long-run level, very close to the GDP growth normally. Capital investment is also just maintenance capex or replacement capex that needs to be done. Profit margins have stabilized. Free cash flow to equity has stabilized. The return on equity is only sufficient to meet the required return. Hence, dividend payout tends to be high, and it has stabilized to that high level because incrementally you are not able to generate more than the required return, so you don't want to deploy too much capital. You can use the Gordon growth model to value companies at this stage. Level Partners is expected to have earnings in 10 years of $10 per share and a dividend payout ratio of 40% and the required return of 10%. At that time, the dividend growth rate is expected to fall to 5% in perpetuity, and trailing P by E ratio is forecasted to be 9 times earnings. Estimate the terminal value at the end of 10 years using the Gordon growth model and the PE multiple. So we are at t equal to 0 and at t equal to 10 the earnings will plateau out, or we want to compute the terminal value. So we want the value at t equal to 10, not at t equal to 0. At t equal to 10, the earnings are expected to be $10 per share and the payout ratio is 40% or the retention ratio is 60%. Required return is 10%. So if we compute the terminal value here, we will need to discount the next year's earnings, that is t equal to 11's earnings. So be careful that you don't make this mistake. So $10 was the earnings, that means the dividend would be 40% of this, that is $4. Please note we are asked the terminal value at this point. To compute the terminal value here, we'll have to discount the dividend of the coming year or t equal to 11 and onwards. So the value estimated by the Gordon growth model would be $4, that is the last year's dividend, into 1 plus the growth rate divided by the required return, that is 10%, minus the growth rate, which comes out to be $84. We can also use the trailing P by E ratio, which is given to be 9 times earnings. And please note it is the trailing P by E ratio. So to the trailing earnings, we can give a multiple of 9 times as an estimate of our terminal value. So the earnings are $10 multiplied by 9, that is $90. If this was given to be the leading P by E ratio, then we would have had to give a multiple to 10 into 1 plus 0.05. That is, the next year's earnings would have been given this multiple. So from the multiple approach, it is $90. From the Gordon growth approach, it is $84. North Aircraft currently pays a dividend of $1. An analyst forecasts growth of 10% for the next 3 years, followed by growth of 4% in perpetuity thereafter. The required return is 12%. Calculate the current value per share. So let's first depict the timeline and then we'll start attempting the question. So t equal to 0 is where we are. At t equal to 1, the company is expected to deliver earnings of $1.1. That is, last year's dividend was $1 and the dividend is expected to grow at the rate of 10% for the next 3 years. So t equal to 2 would be 1 into 1.1 to the power 2, and t equal to 3 would be 1 into 1.1 to the power 3, followed by a growth of 4% in perpetuity thereafter. So t equal to 4, the dividend would be 1 into 1.1 to the power 3 into 1.04. That is, this dividend will grow by 4%, and this 4% growth is then expected to continue forever. The required return is 12%. Calculate the current value per share. So this has to be discounted back by 12%, squared, cube, so on and so forth. Now to solve this question, we would first apply the Gordon growth method from t equal to 4 onwards. That is, we can assume t equal to 3 as t equal to 0 and apply the Gordon growth model because earnings henceforth are growing continuously at the rate of 4%. We will then use our cash flow sheet and explicitly enter these 3 cash flows and discount them back. So assuming t equal to 3 is t equal to 0 and applying the Gordon growth model, the value will come out to be d1, that is 1.1 to the power 3 into 1.04 upon ke minus g, that is 0.12, minus a growth rate of 4%. So this will be 1.1 y to the power x 3 into 1.04 divided by 0.08, which comes out to be $17.3. So the value at t equal to 3 would be whatever is this amount plus $17.3. Next step is to go into our cash flow sheet and to input all these cash flows. The cash flow at t equal to 3 would be the dividend coming plus the present value of all future cash flows, that will be 17.3. So again, press the button CF, and first thing that we do after going into the CF sheet is to clear work so that all previously entered cash flows get removed. Press the button second and press clear work, that is clear out. So you'll see all values will now become 0. CF0 is 0, there is nothing coming in the beginning. So scroll down 1 unit. Enter CO1 as 1.1. So press the button 1.1, that is a 10% growth, and press enter. Scroll down again, the frequency is 1 because this cash flow is repeating only once. Scroll down again. Enter CO2 as 1.1 squared. So press 1.1, press x square and press enter. So you'll see CO2 is equal to 1.21. Scroll down again. CO3 is 1.1 cube. So press 1.1 y to the power x 3 and then add 17.3 because that will be the total and add 17.3 because that will be the total cash flow that is coming at CO3, including the present value of all future cash flows. Press enter, press the button CF, press the button NPV and enter the discount rate as 12%. So press 12 and press enter. Scroll down and compute NPV. It will give us the present value of all future cash flows, which comes out to be $15.2. So the current value per share should be $15.2. Please note, a big value is coming from this terminal growth assumption, or this terminal value that we are assuming till perpetuity. Eastern Fertilizers is a new company and currently pays no dividend. The company recently reported earnings of $2 per share and is expected to grow at a 10% rate for the next 4 years. Beginning in year 5, Eastern Fertilizers is expected to distribute 20% of its earnings in the form of dividends and to have a constant growth rate of 5%. If the required return is 10%, calculate the value of Eastern Fertilizers shares today. So from t equal to 0 to t equal to 5, the company is paying no dividend. Beginning in year 5 doesn't mean it will pay right at the beginning of year 5. It means starting from that year. So from the end of year 5 is when the first dividend will start coming. Year 1 no dividend, year 2 no dividend, year 3 no dividend, year 4 no dividend, year 5 is the first dividend. Don't get confused by beginning in year 5 doesn't mean right at t equal to 4 it will pay the dividend. Dividend will come at t equal to 5. So earnings are expected to grow at the rate of 10%. So at this point, the recently reported earnings of $2 would have had 5 years to grow. So they would have grown to a value of 2 into 1.1 to the power 5. And that is when Eastern expects to distribute 20% of its earnings as dividend. So this will be the dividend payout at t equal to 5. We can denote this as D0. So if we think of t equal to 5 as t equal to 0 for our Gordon growth calculation. Hence we will discount cash flows from t equal to 6 onwards and compute the value at t equal to 5 and then discount it back 5 years and compute the value at t equal to 0. So the value at t equal to 5 will be 2 into 1.1 to the power 5 into 0.2 into 1 plus 0.05 as the growth rate is given to be 5% upon r minus g. This value can then simply be discounted back another 5 years at the rate of 1.1 to the power 5 to compute the value at t equal to 0. So this value will come out to be approximately $8.4. Now this is one formula in equity valuation that you will have to remember. It can also be proven, but precisely speaking this is an approximation. So using the H model, the value of the stock approximately comes out to be equal to so much. Please recall the H model. Earnings degrow from a high growth rate to a low growth rate linearly. So every year the growth rate is declining until we hit maturity some years down the line. If our company is following a model like this or a growth profile like this, then the value at t equal to 0 can be calculated as d0 into 1 plus the long-term growth rate upon r minus the long-term growth rate. So this is the same as the value of the Gordon growth model, assuming there was no high growth period. If the growth always was equal to just GL, then this would have been the value. However, we have some high growth period also, so we need to add that value. That value comes out to be D naught into H into GS, that is the short term high growth, minus GL upon R minus GL. H is T by 2, that is half of the high growth period. So if high growth period is 10, H is the half life, that will be 5 years. So please remember this formula. First part is the same as the golden growth. Second part accounts for this high growth period. So it will be D naught into the half life into GS minus GL. Denominator remains the same in both cases, that is R minus GL. Please note this formula is an approximation. China Furniture currently pays a dividend of $5. The growth rate, which is currently 20%, is expected to decline linearly over the next 10 years to a stable 5% thereafter. The required return is 15%. Calculate the current value of China Furniture. So please note the important term here is that their growth rate is declining linearly. If it just says will decline to 5%, then we couldn't conclude that's the H model. Because the rate is declining linearly from 20 to 5, then we know that we can apply the H model. So the value will be given as the dividend in the previous period into 1 plus GL upon R minus GL plus D naught into GS minus GL upon R minus GL into H, that is the half life, that is T by 2. T is the number of years over which the growth will reach its maturity. So 5 into 1 plus 0.05 upon 0.15 minus 0.05 plus 5 into 0.2 minus 0.05 divided by 0.15 minus 0.05 into 10 by 2, that is 5, will give us the answer as. Finally, we studied that the sustainable growth rate of a company can be estimated as the retention ratio into the ROE. The retention ratio is the amount of the earnings or the percentage of the earnings that the firm reinvests or retains, and ROE is a sustainable ROE that the company is expected to generate forever. Now, this model or this assumption is applicable if we can assume that the debt equity ratio of the company remains the same, the ROE remains the same, and the retention ratio remains the same. So with those assumptions, we can assume that the growth rate will be perpetual and sustainable. We studied ROE with the DuPont formula at level 1. So the ROE can further be broken up as net income upon sales into sales upon total assets into total assets upon shareholders' equity. This is called the net margin or the net profit margin. This is called the asset turnover. And this is called the leverage ratio. So the growth rate is the retention ratio, that is net income minus dividends upon net income into the net margin into asset turnover into the leverage ratio. This is also sometimes called the Pratt model, where SGR is a function of the profit margin, retention rate, asset turnover, and the degree of financial leverage T. So use beginning of period balance sheet values unless otherwise instructed. So you don't have to use the average of the total assets or the average of sales or net income. Generally, in equity valuation applications, use the beginning of period book values or beginning of period assets, etc. to do this calculation of computing the sustainable growth. So that was about the dividend discount model. We will study other valuation approaches in the coming session.